Today is the largest correction that we had to take in dollars since the fund exists. This is obviously a function also of the large NAV we have and the large drop. The fund is down 8% since the last update. This is a big drawdown. We need to talk about this today. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. Well, welcome to the hedge fund world. This is what it feels like. It feels like somebody punches you right under the belt line. You have this feeling of you can't breathe, you're nervous, you're aggressive. I yelled at a lady in our building today for some reason, but still shouldn't have done that. So that's life, and we had a phenomenal year last year. We are up 30. We were up 30% for this year, and now we're down to about 5.5%, and it still feels bad. This is the Not Even Wrong podcast. It's February 22nd, 2021. This is Crim Delco. Since the last update, the fund is down 8.5%. We are now up 5.5% for the year. The market is up roughly 3.5%. We're up from about 2%. The largest drawdown in the history of the fund in dollars. The largest drawdown on a daily basis, and the largest drawdown since the top. Since the top, we are down 24.5%. We reached 29% year-to-date performance at the first week of January. We are now middle of February, and we are up 5.5% for the year. Now, this is still a good performance, no question about that. But nevertheless, this volatility, this large correction warrants some deep thinking, warrants some conversation about what is going on. So let's go through the facts, and then let's analyze, conclude, think forward. What is our positioning? How do we think? The facts are the following. So we had the drawdown in Tesla and the Crispr index, pretty much in the same, almost in the same kind of magnitude. The reason we're still up for the year is actually because Tesla still gives us a few percent. The Crispr index has almost lost all the performance of the year, driven by corrections in pretty much all the stocks. I mean, there's a little bit of differences there. PacBio is doing better. Beam is doing extremely well. Fate is sort of flat. Twist is down. Crispr and Editas are both, Crispr is down a bit, Editas down a bit more. So overall, the index is giving us zero performance for the year. So flat in an up market, that's obviously not good. And then we have Tesla, which is giving us a few percent for the year. And it's not great. Again, these are numbers that we are not used to. But if you look at it from a sort of the perspective of a fund, of a long-term hedge fund, 5% for 6 weeks of the year is still a phenomenal annual performance. So we don't want to complain about that, and we don't want to fall into the trap where we're saying, well, at 20-30% annual performance, that's not good enough. Of course, that's good enough. Our target is 15% unlevered return. We are still above 20% CAGR since inception 2008. And those are the numbers that we live with. And even though we have been exposed to extreme situations like GameStop, like Bitcoin, or even Tesla last year going up several X, it is still worth remembering, or it is actually even more imperative now to remember, that most things in nature don't grow like that all the time. And this doesn't exclude the stocks that we own. So let's first now go through why we own what we own and how we feel about this correction. We own Tesla because of the theme of intelligent electric luxury cars. Tesla is a leader in AI. Tesla is a leader in battery technology. Tesla is a leader in powertrain and battery management software. Those are things we think have large impact on the future of transportation. Tesla is also potentially a leader in ride-hailing, robotics, taxi robotics, etc. So we think that those are large markets that we want to have exposure to, and the purpose of Orange Capital Partners is to generate wealth by investing in fundamentally new concepts and engineering practices with large impact. So Tesla fits right into there. The other large position we have, about 35% of the fund, is in the Crispr Genomics, cell therapeutic, and SynBio index. this is a field that has gotten some positive and negative news recently. I think overall I would summarize it the following: the potential is enormous, the valuations are enormous too. So we're looking at sort of a good and a bad. The valuations are what they are. They will adjust. They will follow a certain trajectory driven by things like interest rates, general purpose, general situation in the market, general feel in the market. They will also follow the actual performance of the company as long as those companies keep delivering and deliver further upside, then the valuations will stay. If not, like in the case of Twist, where we had some, I would say, adjustment of expectations at the earnings call, the whole situation also got a little bit more cautious when it comes to valuation. But overall, I think the thesis here, again, fundamentally new concept. I think CRISPR is a large impact technology, enables enormous positioning, enormous potential, enormous try and error type engineering practices in life sciences. And this is really the great upside that we see in this space. We have recently started looking at distributed networks such as cryptocurrencies and in general crypto technology and blockchain technology as a solution for trust and identity on the internet. This is an area we're just started working on. We are also interested in quantum computing, of course, which is kind of related to, I want to just quote something from Michael Levin from a recent podcast he gave with Sean Carroll. He said, comp science and biology are really the same thing. They study computation just in different substrates. And I think this is really beautifully kind of explaining why we are so excited about our CRISPR index, because it is comp sci in life sciences. This is really, it's just, it's the substrate of life science that is using comp sci technology, comp sci knowledge, comp sci engineering practices, and this is the great potential. Now, as a fund, we also have to understand that sometimes you can be early in a space. I want to quote Mark Andreessen here. Mark Andreessen has said that pretty much every idea that he gets exposed to, he eventually expects it to happen. And the problem is just timing. And this is really what we as investors also have to be very cognizant about. We can be right about all these things. They all can have large impacts. They all can be phenomenal technologies, businesses, practices, but they could also be too early. And that is obviously a risk that we run. Today and the last couple of weeks are kind of situations that make us think like that. Well, maybe we're wrong. What if we're wrong? What if Tesla was just sort of a GameStop game driven by fanatics, driven by algos, fanatics and algos combined, driving up the stock price? What if there is really not that much substance left? What if competition is much stronger than we think? So let's go through these. What is the competition like in Tesla? Is this really a risk? I think competition in Tesla is less extreme than even the market thinks. So we're not just wrong on this one in the sense that we believe competition is not as strong as the market. I think the market is way overestimating competition. There is no competition. Tesla is building an innovation stack. Tesla is impenetrable when it comes to the innovation stack. So the only question left here is, okay, if for some reason electric luxury intelligent cars don't make it, if the market decides that those are not the kinds of cars that they want to buy, well, then Tesla has a problem. But if that becomes the market, if the market really becomes intelligent electric luxury cars, Tesla will own a very large market share of that market. And whoever follows is going to be a distant second and third. And there will be a market for those people on the very high end, on the low end. There's always people who are afraid of the ATM. So there's always reasons why the superior product will not sell. But again, I think Tesla is very well positioned. So competition is not the problem here. Battery technology is the problem in the sense that we're still in the proof of concept phase. Tesla has outlined on Battery Day what they want to do, but that doesn't mean they will succeed. And they could be late. So that there is a risk. We need better batteries. We need better ranges, faster charging speeds, lower cost. We need all these things for the success of Tesla as a company, the success of electric, intelligent luxury cars as a product. AI, same thing. The AI technology, the rewrite, all these things that Tesla's doing are great, but I could just see much better approaches than what Tesla is using. Those are all theoretical approaches. For example, I'm just thinking that blockchain technology could actually be used sort of as a combination of blockchain technology and reinforcement learning with smart contracts. That could be actually used to train and actually guide cars through traffic. This would be a very radically new approach. I haven't heard of anybody doing it, but I'm just saying maybe Tesla is a little bit like the first cameras that were just set up in a theater, making films of theater, and that's why we still call the cinemas the theater. So kind of we're just doing something that is intuitive to us humans by using computer vision and imitation learning to teach cars how to drive, but this is way too difficult. Maybe we should try a radically different approach. And I just stuck in my mind when I look at blockchain technology and Bitcoin in particular. For example, Bitcoin, the way Bitcoin is dealing with transactions, it's not taking money out of your account or back into your account. Bitcoin is using basically money that was sent to you, and because it has a history of all the money that was ever sent to you and all the money that you ever sent, it can always figure out how much money you actually have, and then through consensus, which is driven by proof of work and voting, can make sure that the transaction that you're trying to initiate is valid. So we could have a similar, maybe humanly not intuitive, but protocol-wise intuitive approach towards self-driving and robotaxis. And Tesla is not doing that. But the reason I'm bringing all this up is, look, Tesla is at the cutting edge of business and at the cutting edge of application of engineering and concepts, but it's not at the cutting edge of science. It's certainly not at the cutting edge of theoretically, in principle, possible things. And maybe there are much better ways, and we shouldn't kid ourselves. Not everything they do is always the best possible way, and maybe this approach will have certain barriers that they can't cross, and therefore they will have a problem. While maybe companies like QuantumScape do actually have a better approach and might actually succeed in the long term. Companies like Waymo might actually succeed in the long term, or Comma AI, etc. These are possibilities. We have to be concerned about these things. We are 80% invested in Tesla. 80% of our capital is in Tesla. So we have staked all our wealth, our reputation, our business, our existence on the success of Tesla. Some people might say that's not prudent. We are going with this because all the things we just mentioned, the potential of blockchain technology for self-drive with reinforcement learning, even the potential for, like Michael Levin is talking about, the potential for using living organism and living cells and living intelligence, combined with machine intelligence to create more interesting organisms. All these things are potentials, but they might have 10, 20, 30 years until to market, versus Tesla is going to market right now. And this is the key. The rubber meets the road right there. So these were sort of the situations that I just wanted to clarify again. What is it we're invested in? What is our positioning? Why are we invested? 80% Tesla, 35% Crispr Genomics, and the Cell Therapeutics SynBio Index. Now, where do we stand with other ideas? We're working on the blockchain crypto idea. Like I said yesterday in the episode, it is absolutely paramount that if we find ways to invest in companies that are trying to solve trust and identity by using blockchain technology, this is something we would be very interested in investing. We're staying away from the pure money management type companies like Square and PayPal for now, but these are sort of, this is definitely an area of interest, and then the quantum computing side is also an area of interest. Now here's a new thing which just happened today, and this is a big macro shift. Today what we saw in the market is what we call a rotation away from companies like Tesla into companies like oil and old technologies. It's the reverse ESG trade that happened today. We have the Nasdaq down 2.5%, the Dow up. We have Tesla down 8%. We have UPS, FedEx, oil stocks up between 3 and 5%. We have Deere, Caterpillar. This is a call on the US economy to recover strong. CapEx to go up. The US economy as an economy will get back on its feet. This is what happened this is the trade which got triggered today. And in that sense, what happened today, as bad as it is from a drawdown, is not so concerning to us, because in a strong US economy, there's no reason to fear our companies will not do well. They will do well in a good or bad economy, and they should actually do better in a better economy. So that's not the problem. What is the problem? Raising interest rates. That's possible. Higher interest rates make leverage less possible. There's probably more leverage in stocks like Tesla, even in the biotech stocks, than maybe in stocks like Caterpillar. So that is a risk. We have to live with that. In fact, we ourselves have to live with the leverage, and I've stated that many times in the podcast, that the main degree of freedom, other than, of course, in choosing where to invest in, is the amount of leverage we use. We use 15% leverage at the beginning of the year. The idea being that with a 50% drawdown, we should be at something like 25% leverage. So we don't want to overdo it. We don't want to be margin called. And 15% leverage, given the low interest rate environment, is a reasonable amount of leverage. And this is, of course, our biggest risk that we have right now. Further, we have now a macro conversation, and there's a potential for a trade here. And we discussed this today in the meeting over a couple of hours, actually. Well, how will we position ourselves into this macro situation? And the conclusion is that the best way to play macro is with macro. So, hit the nail with the hammer that is supposed to be used for the particular nail. Don't try to be cute. Don't buy, let's say, industrial or cheap stocks or whatever, or value stocks just because you have a recovery, because the real money is always made with macro if you want to play macro, and it's made with real innovation if you want to play innovation. You can't just sort of use derivative stocks or something like that, or proxies for a theme. Try to find the right theme and the right investment for the theme. And if you can't do that, then don't invest. So when it comes to macro and US, the main drivers are interest rates in the US and US dollar. The interest rates have already risen from about 90 basis points in January to 1.4% on the 10-year, which is a massive move. The interest rate curve has steepened, which is a good news for the economy, and this reflects the positive attitude of market players towards the economy. So that's a good thing. We had today a massive rotation into more cyclical, more industrial stocks. That's all good. The one thing where we see opportunity to make money is with currencies. What's not priced in yet in the market is a strong recovery of the dollar. The dollar is kind of written off as a dead asset. The future is cryptocurrencies or the euro or something like that. And the dollar, because of the money printing and the democratic regime in Washington, will just be a wasted asset. This is the thesis in the market. And I think, like everything else in the market, the real money is always made with controversial calls, with contrarian calls. This is a call I want to make today, which is my contrarian call is that if the US really recovers, if the yield curve reflects a strong recovery here, we will have a very strengthening of the dollar relative to pretty much any currency, in particular emerging market currencies. So the trade is to go long dollar, short emerging market currencies, a basket of particularly Latin American currencies, and then you can throw in pretty much any other currency, maybe with the exception of the yen and the Swiss franc. And the reason for that is we have one of the side effects of all this money printing and the Fed has been that the Fed has become the banker for emerging markets. The access to dollars has been very easy in the last 6 to 8 months because of COVID. The Fed has opened the floodgates, not just inside the US, but also for outside investors. And this is, in my view, part of the reason why, for example, commodity prices are up, because if you take a country like Brazil or countries like that, they are typically, that's what they do. They borrow in dollars and invest in what they know. And very often, let's say in Chile, people know copper. So they invest in copper either directly or indirectly. Or in Russia, people buy ETFs with nickel and palladium and things like that. There's a lot of things that are driving these types of trades. I don't want to go into details, but the one thing that always happens, if you go back in the history of macro investing, Soros, Hugh Henry, and people like that, they've always made their most money with currencies. And the best money is always made when there is a shift away from a weakening dollar to a strengthening dollar. The problem with this trade is the timing. So if we're right, if the US has a recovery right now, it will take some time. And in particular, in the first phase of the recovery, everybody's happy-go-lucky. We have a Goldilocks environment globally, so those currencies might actually even strengthen for a while. But there will be a point where there's sort of a breaking point, where the leverage kicks in, where the strong dollar starts squeezing those countries, and then we have the large corrections. I'm not talking about situations like Venezuela necessarily or Argentina, but it's along those lines. Another very strong indication that this could be an interesting trade is that right now, in particular in Latin America, for example, Brazil, Colombia, countries like that, Chile, their currencies are already almost at all-time lows relative to the dollar. So even now, even after all this money printing, even after all this easy access, their currencies have barely recovered. So what we foresee here is a possibility of a sort of Lebanese type situation where the real goes from 5 to 20 to 100. So it goes down 4 to 20x. It loses 80% of its value. That kind of massive correction is possible. The timing, a little bit more difficult. The way we would put on a trade like that is sort of in a Hugh Henry style, very little risk, some maybe upside calls or puts, depending on which side you look at, where you buy out of the money calls, let's say on the real dollar pair, meaning you say, let's say I buy the 15 strike real to dollar pair. Now the real is 5, so this is way out of the money. So you can buy this. You can put maybe 0.5% of capital at risk for 2 years, and if you're right, you can make 50% return or something like that on your portfolio. So it's a massive risk reward. Those are the kinds of trades we're looking at. It might be difficult to implement those trades with our prime broker Schwab, but this is, again, this podcast, it's not just about what we do, it's also to give people a sense for what it feels like to run a hedge fund. So this would be our biggest new trade idea that we're working on. This is really interesting also because it's macro, and Orange Capital Partners actually started out as a risk-off special situation fund, then became a little bit of a macro fund during the crisis in 2008 because macro was the big theme, and then we've morphed into disruption fund with fundamentally new concepts and engineering practices. But the macro side is still there with us, and we are still very happy to engage in opportunities. We are an opportunistic hedge fund. We look at opportunities when they arise, and this could be an interesting opportunity because we have this shift of the US strengthening, the US financial markets pricing in strengthening, and on the other hand, we don't have the correction on the dollar side yet, so this could be a very interesting trade for the next 6 to 12 months. So conclusion, largest drawdown in the history of Orange Capital Partners in dollars today, in 1 day, and also since the peak by the first week of January. So in the last 5 weeks, we have had a drawdown for about 24%. So in dollars, that's very, very much. I mean, the highest we've ever had. Also in terms of percent, it's very high, but definitely in terms of dollars. We are, of course, monitoring the situation, but there's really not much to do for us. We are okay with our positions. Like I discussed, the reasons we're in those positions have nothing to do with the correction. The correction is a rotation, it's a repositioning of marketplace, it's to some sense also a delevering of the system to some extent. So the Robin Hoods of this world, the GameStops of this world are being washed out of the market. So there's some of that, and this could continue. We are okay with a 50% correction. This is sort of our worst case scenario. If it goes below that, we might have some problems with margin calls. Of course, we don't expect that to happen, nor do we hope that or anything like that. But this is kind of the way we do our worst case scenario, 50% correction from the beginning of the year. We are up 5% for the year now, and hopefully we won't have to go through the worst case scenario. Hopefully we can stabilize here and then continue with the fundamental improvement of our businesses and our portfolio. Thank you.